Howdy, Jacob here. Today we're looking at Camping World Holdings in the specialty retail industry. 1 billion market cap with over double for enterprise value, meaning that they have a lot of net debt here. There was some big growth for the last 10 years, over double in revenue, but it looks like the most recent year they did have a 10% decline. If it's what I'm thinking, I could easily see how from COVID it jumped up pretty heavily and then is going back down to a more natural rate. But they operate as an RV and outdoor retail. Makes sense. It also offers extended vehicle service contracts. Okay, interesting. Founded in 1966. It has been around for quite some time. So this type of growth is pretty impressive. And they have started to pay a dividend. It is a 2% yield, which is pretty high. And the most recent year, again, they had some trouble on the revenue side as well as the earnings side. So they actually paid more in dividend than they made in earnings per share. But if they're able to get back to that $3 to $6 range, then it should be a reasonable payout. I'm just not entirely positive whether that's going to be the case or not, because they did reduce their dividend by one entire dollar from a year ago. Return on invested capital recently has been pretty poor, mid-single digits average. Their balance sheet shows 40 million cash on hand with 1.5 billion long-term debt and 1.4 billion short-term debt. I'm extraordinarily concerned about this short-term debt. 1.4 billion debt due within the year, and they only have 40 million cash on hand, and their production of free cash flow on a generous basis is 150 million. So that might be enough for me to just, personally not invest in it, but I'm still going to do an analysis. But for me, that debt is just way too concerning for me. It's historically been very high, but that's not something I want to understand and I want to dig into. And so for me, I'm probably out, but let's complete the analysis either way. So for revenue growth, I don't even look at cash flow. Their use of cash is mostly acquisitions. And again, they go into debt to fund that and to pay a dividend. So right now, dividend, I'll say, you know what, stick with 50 cents. That's fine. The remaining money is really just going towards dividends. Or, if anything, let's divide that by 2, free up some cash, and then maybe a tiny bit to acquisitions. We're going from almost over 100% the last 2 years to down to 20%. So maybe every 5 years they get 150 mil a net acquisition. So I think that's able to give them 4% revenue growth. And then we're going to do a wide range here on the margins because that's what we're seeing here. For the P, price to free cash flow, I think they're below market and enterprise value is way higher. So maybe let's do 10. And then for share change, they issued a bunch of shares, it looks like, recently. But historically, I think they can. Well, stock-based compensation is 22 million. So let's say they increase shares 2%. Because again, we're saying a little bit of free cash flow goes towards the dividend, a little to acquisition, and the rest to debt reduction. And again, even with this saying 43% drop, this might just be a company I just look at something else. There's too many companies out there for me to want to figure out every single company, and especially if they have as much debt as they do, especially short-term debt. That's something I'm a bit concerned about. But either way, I hope you enjoy the video. Have a great day. Thanks.